the importance of the metrics, cash flow being number one, is critical to the operation and the success of the property long term. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, welcome back to the show. I'm your host, Todd Dexheimer. I want to talk about some terms and things that we talk about when we're looking at investing in real estate, whether it's multifamily, retail, single family, doesn't matter. Single family, probably a little bit less, because here's one of the benefits of single family. I was just thinking about this the other day. Sidetrack, by the way. Now what we're talking about, but with single family, it's emotional. So that's the benefit, and that's the curse with single family. It's an emotional buy and sell. And so if you can buy a single family non-emotionally based on the financials, and you can cash flow that property and not have to worry about when you sell it, that really plays well into your favor. You can get long-term fixed debt, and you can just sell it kind of whenever you really feel like it. It has nothing to do with the financials. So it's just thinking about a property of ours that we have, and we've got a ton of equity in it. So it's great, but it's not performing as well as what we would like to. We're not in love with the market. We're kind of exiting the market. It's in Tennessee, and we're just kind of exiting the market. And again, like, we have a ton of equity, so it's great, and we can sell it. We'll make a bunch of money and all that. But the thing is, the returns to us, our profit, is so based on the performance of the property. So if we got the performance of the property up significantly to where potentially it could be, like we would like to think it could perform much better, then it would sell for a whole heap of a lot more. But if we sell it right now, not that we're going to take a loss, we're going to have a great gain because we bought it really, really well, but it's not nearly as much. It's all based on financial performance, where if that was a single family house or a bunch of single family houses, we could just sell it right now because the market's on fire, right? It's just like single family houses. Everybody wants one. There's a shortage of them, and we could just sell it. It would be easy as can be. Now, at the same token, you could say, well, what happens if that property sucks and you don't like it and you want to sell it and the emotions are low, like in 2008 through 2014? Yeah, okay, yeah, good point. It wouldn't work out too well. But if we're cash flowing, we don't have to sell it. And I guess same thing, multifamily, if we're cash flowing, we don't have to sell it, and that's what we're going to do. We're just not going to sell it for a little while here, and until we're basically ready to get rid of it. All right, so let's talk about the topic at hand. The topic at hand is I want to talk about some of the important kind of language terms that are used, and things that I want you to really think about as you're thinking about investing, and understand what they are. So some of these terminology can get confusing, and what's important and what's not. And so I want to talk about, to me, what's the most important metrics to look at, and what the metrics are that are either semi-important or very, very important. So I think, so I'm going to talk about two kind of different variations of metrics that we want to be looking at. First of all, it's our own returns. And second of all, it's the property performance metrics that we want to be focused on. So let's start with the property performance metrics that we want to be focused on, because that ultimately drives our returns that we want to be focused on. So first thing, when we're talking about property metric performances, that we want to be focused on, I think the most important and the most critical, and this is going to be very similar to, by the way, by your returns, the most important, most critical is going to be your cash flow. And so that's what drives a property. And this is my own opinion. Some people disagree with me. Some people think that building equity is the most important thing, but you can't eat equity. Equity, to me, is more of a puffing your chest. I've got all this equity. I've got this huge net worth, where cash flow is what is real. It's literally coming in the door right now. And so I think the importance of the metrics, cash flow being number one, is critical to the operation and the success of the property long term. And that is what drives any business is cash flow. We need money in the door, true money in the door, not just the gross amount of money, but the true money. We're talking net income, cash flow after all expenses. That is what drives everything. So if I'm looking at a property and I've got negative cash flow, I have to figure out, is this property worth me purchasing? Can I get to a positive cash flow quickly? And if the answer is, well, no, but I'm driving a ton of equity and it may not cash flow, I think that's a garbage investment. I really don't think that's a good investment. You should not consider that investment. And people do. Trust me, they do. But I think that's going to only get you into trouble in the long run. So to me, cash flow is what drives everything. And as you're analyzing properties, you really have to think about all the expenses associated with that property. I can remember talking with a guy who had a duplex, and he was talking about how cash flows $800 a month. And I was asking him about, I knew the price he paid for it. And I thought, man, you paid a lot of money for that property to cash flow $800 a month. It just doesn't seem possible. And he put a loan on it, 80% LTV. And so I'm going, man, so take me through some of these numbers. And the numbers he took me through, he totally missed replacement reserves. He totally discounted how much it's going to take to maintain that property. He totally missed, the leasing cost that it's going to take to keep it full, right? Just it doesn't cost you any money to lease if you have no vacancy, but the second you have vacancy, you've got turnover costs, you've got leasing costs, right? So you've got costs that happen. And if you don't take that in consideration, that's not your true cash flow. So I think, again, not to keep on belaboring, but cash flow is, in my opinion, number one. That's what drives everything, including your future value. Okay. So the next thing I want to talk about is the cap rate. And the cap rate is a driver towards future value. And so I think it's an important metric to look at before we look at the future value. And so when I look at the cap rate, and we're talking commercial real estate, multifamily commercial real estate, single family is not driven on cap rate. That's just driven on appraised value or in again, emotions, right? And even duplexes, fourplexes, those aren't really driven on cap rate so much. A little bit based on cash flow and kind of, that type of thing. But we're talking cap rate for commercial. So when I'm looking at my exit, I have to look at what the market cap rate is today and what I think emotionally where the market's going to be when I plan on selling. And here's the thing, cap rate might be almost of no significance if you're planning on holding long term. Then we just have to look at cash flow, and we have to look at opportunity of what we can do to the property. And then cap rate means nothing. Cap rate only means something if we plan on selling within probably honestly within about 5 to 7 years. If we don't plan on selling in 5 to 7 years, cap rate almost means nothing. So all the cap rate is, it's simply a basically it's your net operating income divided by your purchase price, right? And that's your cap rate. And so if cap rates go up and down, we've heard a lot about cap rate compression, which was happening up until about 2022, meaning that if I bought at a 5 cap, if I bought at a 6 cap, I could sell for a 5 cap. That's a really good thing that drives value. Now we're seeing the opposite. We're seeing decompression. And so you buy at a, call it a 6 cap today. Tomorrow it's going to sell at a 6.5 cap, or you bought it at, in 2022 at a 5 cap and now it's a 6 cap, right? And so could we see compression again? Maybe, but I wouldn't count on it. All right. So I want to move beyond cap rate because that one to me it's important, but I think what's really important is just understanding what's going on in the market, like what the cap rate is in the market. You could do that research. You can get some CoStar reports. You can ask the brokers, like kind of a combination of those things, and understand like what properties are selling for in the market. And then look, that's kind of what your property is going to sell for 5 years from now. Maybe you add a little bit to it. So if it's a six cap, maybe say 5 years it's going to sell for a 6.5 cap. All right. So I talked about cash flow. I talked about cap rate, but I want to go back to kind of the cash flow. And this metric, in my opinion, is after cash flow, and it's related to cash flow very greatly, but it is maybe even more important than cash flow. And it's the debt service coverage ratio, the DSCR. I had a whole podcast episode about, I don't know, maybe 10 episodes ago on debt service coverage ratio and why I think it's so important. And I'll just kind of give you the Cliff Notes version. Debt service coverage ratio is just telling me what my ratio is from my net income, my net operating income to my mortgage payment. And so that, and which NOI minus your mortgage payment gives you your cash flow. But I want to know my ratio, and what the ratio tells me is how tight it is. Okay. So if I have a cash flow of $100,000 and I got a debt payment of $100,000, that means I have a debt service coverage ratio of 1, meaning I'm break even, right? Now, if I've got a NOI, net operating income of $125,000, and I've got a debt payment of $100,000, then I've got a 125 DSCR, debt service coverage ratio. All right. So that means I've got a little bit of wiggle room. That means I've got some fluff there to be able to make some mistakes and still be at least cash flowing. Right. And so the higher we get that number, 1.5, 1.75, 2. We have a couple properties that are well over 2. We have even a few properties that are in the 4s and 5s, right? So the higher we get that level, the more cushion we have, the more that we can say, hey, things could go wrong. Like what happens if vacancy goes up? What happens if expenses go up? You might have a month or two where that really happens. And can we cover our mortgage payment? Where's our break even cost? Our break even, occupancy and expenses and income and stuff like that. So that's really important. Debt service coverage ratio basically means you can pay your mortgage every single month. And most banks are going to want a 125 DSCR, 1.25 DSCR to know that you can actually pay your mortgage. And if you get below that, they start to get a little worried, and they depending on your loan documents, they could maybe even take the property back. So DSCR of 125 or above is a good thing. We definitely want to make sure we can pay our mortgage every single month. Okay. Net operating income, I've mentioned several times. So net operating income is just the income, all of the income minus the expenses, but that does not include your mortgage expense. So your net operating income kind of is your guide if you were to buy it cash. Think of it as if you buy it cash, that's your cash flow, is your net operating income. When we have a mortgage on it, of course, the cash flow is your net operating income minus the mortgage. So it's all your expenses minus all of your income minus all of your expenses, but not including debt service. I think another really important metric to focus on, and by the way, this one can trick people and trip people up. And I think sometimes it's thought about a little too much and paid attention to a little too much without really understanding the metric. So this one's a little trickier metric, but your operating expense ratio is a really important metric to understand. And the reason why I think that's super important is because every property type in every market has an operating expense ratio that is very common, and it's really hard to drive outside of that operating expense ratio. But our goal is to always maximize that operating expense ratio. So what does that mean? So when I hear people say, well, multifamily operates at about a 50% operating expense ratio or expense ratio, meaning that your income is essentially double your expenses. 50%. Now that's just a blanket number, and that's why it gets people into trouble because people are like, "Oh, this is a great property. Look at the cash, the cash coming in is $1 million. So that means my NOI should be $500,000. Ooh, what a great deal! I can pay this asking price, and I can run this property really well. But if this property is a 1965 property that hasn't been renovated, it's maybe in a rougher part of town, has central boiler heat, has a whole air handling, system that you pay for as the landlord. Like, wait a second, your operating expense ratio is going to be much greater, and it could be, 70% even. So you have to look at it and go, what is the market for this actual type of property? I mean, we've got a brand new construction property. The operating expense ratio is not even close to 50%. We're talking like 35, 38%, right? So every property type has a different operating expense ratio. I think it's really important to understand your specific market. It's all factored in, right? What are the insurance costs? What are the property tax costs? What are the utility costs? There's hard costs that you can't really change, and then there's some soft costs that you may be able to change. But even that, like, you're gonna have to spend money on maintenance. You're gonna have to spend money on, on turnover, all that kind of stuff. So, payroll, that type of stuff. But those are things that you can maybe affect a little bit by doing a renovation, or hiring different people, potentially staffing differently, potentially using some technology, that type of stuff. But we want to be careful, that we don't get kind of too crazy with that. All right. So there's another one, I think is important. I probably should have said this right after debt service coverage ratio, is LTV, or loan to value. And so loan to value is simply meaning what the value of the property is based on, really what the purchase price is, right? So sorry, what the value of the property is, based on what the loan amount is. So I want a loan amount that is lower, obviously, than the current value. And I want to make sure I've got some equity. I said before, equity you can't eat, but it is also important when we're looking at a mortgage that we want some room there, some room to breathe. So you can get really aggressive, and you can potentially just put a 20% down payment on it and have a loan LTV of 80%, loan to value of 80%. Boy, I mean, that is really tight. What happens if things go wrong? All of a sudden, your equity is gone really quickly. We saw it erode in this market, for multifamily, where building values lost 20 to 30% overnight. If you had an 80% LTV, you literally have zero equity. And so you can't sell that property because you can't pay the mortgage back. And in many cases, it actually was even higher than that. So, you've got a loan for 10 million bucks, and maybe you only can sell that property for 8 million because you maximized the LTV too much, right? You got way too much. And so I think it's really important. It's the second most important thing to look at when you're looking at a mortgage. DSCR is the first one. Is second one is the loan to value. You want to make sure you have some equity. We like 60 to 70% loan to value. That gives us some fluff. It still can erode. Don't get me wrong. Like, it still can erode. But we like to see that. I think DSCR is more important because if I can get a 60% loan to value, okay, but if I have a 60% loan to value and I have a 1.15 DSCR, that means I can barely pay my mortgage even though I got that loan to value. That means the property is likely overpriced. That means that the appraiser just came in and gave you the price that you're paying for it. It does not necessarily mean that's what the true value of that property is. So LTV can get a little tricky because LTV is based on somebody's opinion of value. It's not necessarily based on what the market actually is. Um, I, so just you gotta really think through that. It's really the DSCR that drives it. LTV is next. Um, all right. I want to turn to, oh, the last thing I want to talk about is CapEx, and that one's really important. Capital expenditures, CapEx, really important that you factor the CapEx into it, and that'll help your operating margin as well, right? So that's going to really help your operating expense ratio if you factor in enough CapEx into your project. You want to make sure you have plenty of money, right? Plenty of money to be able to renovate property, to be able to cover big expenses like roofs, like HVAC, like plumbing, all that kind of stuff. You want that money up front and you don't want it out of cash flow. All right, let's talk about metrics that I want to see and I aim for my investors when I'm looking at a property. So if I'm going to invest in a property beyond what I just mentioned with the property metrics that I think are really, really important. So number one for me is DSCR, and cash flow. So those kind of probably are hand in hand. Number one and number two is DSCR and cash flow. I really want to drive high DSCR and high cash flow. Those are basically the main metric that I'm looking for. Number two would be my equity. I want to make sure I have equity that I'm building in the property. I want to make sure that I have some room there to be able to sell it. So I am looking at how can I create the most amount of value by doing a value add, by creating equity. And that leads me to having a really good, solid LTV, loan to value. So I'm at, 60 to 70% LTV, or maybe even better, right? A lot of my single families, duplexes, things I bought way early on, even some of my earlier apartments that we've held for a while, we've driven enough value to now we're at, 30 to 50% LTV. And so I really like those low LTVs. That allows you to do a refinance. And today I'm not going to do a refinance just because the rates don't make sense, but it allows you to do the refinance when the rates make sense, and pull some capital out tax free, right? I can pull some of that money out tax free, continue to cash flow, and now reinvest that capital into the next deal. So that's really what I want to drive. What I'm driving my values, driving my LTV. I want to be able to drive for a refinance so I can continue to do business with tax-free money. That's awesome. So let's talk about our own returns that we're looking for. And similar to cash flow, I want to make sure I've got good cash on cash returns. So what am I looking for? I'm looking for how much money I have to put down to how much money comes into my pocket, right? And so I want to look at that ratio or percentage of cash flow. So I'm looking at cash on cash return. Let's say I have to put $100,000 down. I want to make sure that I'm making good money every single year off of that. So you have to decide what's good for you. Is it 3%? Is it 5%? Is it 10%? Or is it greater than that maybe? I want to see at least an average of 8% cash on cash return. Now, that doesn't mean it has to start out with 8% cash on cash return, because if I'm driving a value add property, I might be a little bit lower. We're purchasing some properties right now. We're projecting to have about a 5 to 6% cash on cash return in year one, but that'll grow as years go on. The reason why it's only 5 to 6% in year one is because we're doing value add to it. So we're renovating units. So we're going to have higher vacancy in the first year. We're going to have higher turnover in the first year. We're going to have some concessions potentially in the first year. Our expenses are going to be up in the first year. So those things are going to drive higher expenses, lower income, to be meaning we're going to have less cash flow. As we've finished renovations, now we're going to be driving revenue. Now we're going to be driving occupancy. Now we're going to burn off those concessions. We're going to burn off the loss to lease, and we're going to have more profit. Right, our expenses are going to go down because we've got renovated units, and so our cash on cash return should drive from 5 to 6 to 8 to 10, and we're going to have good cash flow. So that's kind of what I'm looking for as I look at cash on cash return. I want to make sure that during my hold period, I've got really good cash flow. The other thing I really love, and I just mentioned this, is I love to have the opportunity to refinance. Now, refinances only make sense if the market plays well with you, if interest rates are good, if you keep a solid DSCR. That's the thing. When I talk a refinance, that's a whole nother podcast episode. But when we're talking about doing a refinance, you want to make sure that you're keeping good DSCR and good LTV. That's super important. But that's going to drive a higher cash on cash return. So if I return 50% of my capital back to me, now I can use that $50,000, the 50% of the 100, that $50,000, I can use that to invest in the next deal. And I still have $50,000 locked up, but I'm going to have cash flow still coming in. So maybe my cash on cash return, instead of being based on 100,000 at call it 10%, is now based on 50,000, and now we're getting 16%, 15%, something like that. So we've got a really good cash on cash return now, and we can take and invest that 50K that we got back into the next deal and maybe get 8 to 10 on that one. Um, so that's, to me, the driving factor: cash on cash return. Internal rate of return is something that a lot of people really focus on. And a lot of syndication companies, such as mine, really focus and push on internal rate of return. I used to do that because that's a metric that kind of everybody loves, but I focus less on it now, quite frankly, because I think it doesn't mean all that much or nearly as much. So what an internal rate of return is, it's taking into consideration the time value of money, but an internal rate of return is looking at your profitability throughout the entire project. So it's looking at the cash flow that you receive in year one, year two, year three, year four, maybe year five, depending on whenever you sell it, right? Year six, seven, eight, nine. Doesn't matter. Whenever you sell it, takes all that cash flow, adds it up, and it takes the equity that you built at the end. So the profit you get from the sale. So if you've paid off some of your mortgage, if you, whatever profit that is at the end of the sale, takes and adds all those together, and then it looks at how much you invested. So you invested $100,000, maybe, and you got your $100,000 back, of course, and then maybe you made cash flow of $25,000, and then at the sale you made $75,000. Okay, so you get your $100,000 back, plus you make $100,000 in profit. And this was over a 5-year period of time. Now, that's maybe a 15 to 16 IRR, right? Internal rate of return. So what it's doing is essentially it's very, very similar to your average annual return, but it's taking consideration the time value of money. So the rate that you could have reinvested that money is actually going to lower your return if you're not able to make money on the profit that you made. So that's an important metric to add back into it. Is if you, let's say you're cash flowing $25,000, and you reinvested that cash flow in, even if you've got simple interest at a bank of 4%, you'd want to factor that into the overall IRR, right? Because you're taking the whole picture. And so here's why I discount IRR is because, and here I think this is the most important part about IRR, is that a lot of people, when they're considering IRR, what they're doing is they're looking at the biggest number they can find. What they're forgetting about is the IRR is a number oftentimes driven, or not oftentimes, always driven on a sale, on an exit. So it's a future value of that asset. And we don't really know where the market's going to be in the future. So IRR is so driven on the future value. And then the IRR can also look prettier and bigger if you sell the property sooner. So it might not be in the best interest of you as an investor to sell the property in 2 years or 3 years. But if you're investing in a syndication, and I simply want to drive IRR because that's a cute, cool metric to show people, I'm going to sell the property as quickly as I possibly can because that's going to drive higher IRR, right? So there's a lot of people that bought properties in 2019, 2020, 2021, and they sold properties very quickly. And if they sold properties within 12 months, 18 months, 24 months, they drove huge IRRs, even if their returns or true real returns weren't all that great. And you've got, of course, anytime you sell, you've got huge tax liabilities. And the shorter it is, potentially you've got even bigger tax liabilities. So what they were doing is they were driving on paper IRRs to look really, really sexy, really good. And yet, in reality, if you look at what they were doing, was it really that good for the investor? Probably not. Like it would have been much better for the investor had they not been driving the IRR. That syndicate, those syndication companies were really only doing it for one reason, and that was for themselves, to give themselves a better track record, to make themselves look good, to make people excited because they can show big numbers. So to me, IRR can be a tricky one. It can trick you as an investor to think you're getting a better deal than what you truly are. And the other thing is it's again so driven on the exit that you can get enamored with IRR on these deals that are super high risk. They've got no cash flow or fake cash flow. We can talk about that. But they've got no cash flow or very, very little, and it's all driven on the exit. And again, like that's much higher risk. If I am driving my future value, my investment based on a future value that we don't know about, that is risky. It's just how it is. That's not a true real estate investment. Okay, that's a like yeah, I liken it to a investing in a Bitcoin. I liken it to investing in a startup company. Those are investments, and I'm fine with them. But that's not what most people think of when they think they're getting into real estate. Is they're thinking they're getting into something safe, secure, preservation of money with some decent returns. They're not thinking they're getting into something that is high risk, potentially high reward, but very high risk. And that's when you're just driving IRR, you're not thinking about the rest of the metrics. And that's the number one. That's where you get into trouble. All right. Enough on IRR. Again, cash on cash to me is much more important. Um, the next metric that I want to talk about is the preferred return. And the preferred return for investors can be a good thing, but it can also be a bad thing. So why is preferred return good and why is it bad? So for preferred return simply means that if you're investing in a syndication, that you as the limited partner, the one who puts the money in, is getting a specific return. That's the preferred before the general partner actually makes money. And so let's just say the preferred return is 7. Most of our deals, we offer a 7% preferred return. So if you invest $100,000, you get $7,000 per year before the general partnership gets any of their splits. Usually there's a 70-30 type split where above that 7%, then you as the LP, you as the limited partner get 70% of the profits and the general partner gets 30% of the profits. Why is that not necessarily a good thing? So sometimes that might not be a good thing. And why could that be a bad thing? Because it really incentivizes and drives the general partner to exit the asset, even if it's not in your best interest. And so what we are doing now is when we refinance, that can reset the preferred return. So that drives an incentive for us to look at both scenarios, a sale and a refinance, to drive that. Now, some people say just get rid of the preferred return. And I actually can't disagree with them. Getting rid of the preferred return really, in my opinion, is the best alignment of interests. We are protecting our interests as a general partner by eliminating that preferred return, meaning we're going to work our butt off for that deal in all cases because our profit is based on the performance and the performance alone. Where a preferred return, you might have this big hurdle, and if the property is not performing, you get the wrong general partner and they just go, look, we can't make this preferred return. We're never going to make it for our investors. We're never going to get above it. And even if we do, we're only barely above it. We're not going to make any more money on this deal. Like, why are we working so hard on this asset that we're just not going to make any money on? And so we're going to give up on this asset we're going to focus on our other properties that are actually making us money. And, it is what it is. Let's just sell this one and take our losses. And again, that's the wrong partner, of course, but that's a true scenario that people deal with. And so if I don't have a preferred return, then as a general partner, I still see the profitability there. And I know, look, if I work hard on this, I actually get rewarded on it. If I refinance this, I get rewarded on this. If I sell this, I get rewarded on it. So no matter what I do, as long as I work my butt off and think about what's best for the asset, I'm going to make good money. And that's what they're in for. So I think preferred return, although it protects investors' downside by saying, not a guarantee, still not a guarantee, but by saying, hey, 7% before the GP makes any money, it disincentivizes the GP, and it really forces the GP's hand in many scenarios. All right. The last one I want to talk about, actually, two more. Equity multiple. Equity multiple is simply how much money you invested. So $100,000. Did you get that $100,000 back? And then how much money did you make over the life of the investment? So they're very similar to IRR, but we're looking at it a little bit differently. So what we're saying is, let's just say scenarios we invested $100,000 and we got some cash flow during the hold period, and then we sold it, whatever, call it 2 years, 5 years, 10 years down the road. Doesn't matter. Time doesn't matter in this case. And so we sold it, and we got our money back. So our original investment we got back. So that 100,000 we got back. Plus we made over the cash flow and the exit, we made $100,000. So now we have $200,000. We take that $200,000, we divide it by our original investment. In this case, it's $100,000, and I've got a 2.0 equity multiple. So I've 2x'd my money. I doubled my money. That's kind of a really simple metric. We like that metric to say, hey, our goal in 5 to 7 years is to double your money. That's a pretty simple way to look at how we're doing. Is can we about double our money? The next one that we can look at is your AAR, your average annual return, and essentially it's looking at almost the exact same way, but we're looking at it as a percentage. So we're taking then in consideration how many years did we hold it. So if we had an investment that we invested $100,000 and we made $100,000, that's 100% return. And then if we divide that by 5 years, our average annual return is going to be 20%, right? So that's we're still doubling our money in that 5 years, and our average annual return is 20%. That's different from cash on cash, because cash on cash was just looking at that hold period. You can also look at cash on the exit, but that's just on that year. So, all right, lots of stuff, maybe too much into the weeds, but I hope that makes sense to you. There's a lot of things to look at, but to go back, in my opinion, it's all about the cash flow. It's all about how we're operating that business right now, today. Future is great. We want to drive future value. We want to do everything we can to build equity. That's why we do value add. But today, right now, how we're operating and what we're driving to the future matters much more. That's what tells us the true story. It's easy on paper to look good in the future. Super easy. Everybody looks good in the future, but how are you in the present? That's what I want to focus on. That's what I think you should focus on, is how are you in the present? Certainly looking at how you can expand and grow in the future. But if your sole decision is made on what the future looks like, I think you're making a big mistake. All right, that's all I got for today. You have a fantastic rest of the day. Make every day a Saturday. Hey, thanks so much for listening. I appreciate you being a loyal listener. Say, I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.